Hello everyone, welcome back to the channel, the moment you've been waiting for, including myself. I'm back with Nick Piquard, head of options at Hamilton ETFs. How's it going, Nick?
Going very well, thank you.
Awesome. I hope you have some time and some water because we've got a lot of questions today. We're going to talk about the DayMAX ETFs, all about them. We're going to dig deep into them, and we're also going to take some questions from members as well near the end. So let's get started with something very simple. Why did you guys decide to launch these now? Have you been monitoring the zero DTE space in the US? We know in the US there's already quite a few of them that are out. Tell me.
Yeah, no, look, this is a market that we've been looking at for a little while. It's a growing market. The zero DTE option space is now such a big part of the options world. We noticed more and more investors are looking at these options. They're looking at these products, and we've been looking at these for a little while. But we also wanted to make sure we came out with an ETF that that we liked. We wanted to make sure that we had the proper team in place, that we did all the work necessary to make sure everything went smoothly, and everything came together.
Yeah, that's great. Yeah, it's funny. I actually saw a comment in the YouTube video saying, "Isn't Nick going to be overloaded and super busy?" But you guys have a team, right? It's not just you. You have a team of experienced options traders, and I believe you hired a few new ones. We won't have to get into it, but you guys are good in
No,
terms
but
of.
it's a good point. We've been hiring additional portfolio managers, traders. We have one of the most experienced team now in terms of portfolio management experience and cover calls in Canada. So we wanted to make sure we had the right team in place. We didn't want to rush into things and get into trouble. So
Yeah.
we feel like everything kind of we the timing was perfect from our perspective. And furthermore, I think the market really wants these products.
Yeah, for sure. So just in case my audience doesn't know what we're talking about, we are talking about these three brand new ETFs here, cover call ETFs, CDAY, SDAY, and QDAY right here, which of course you could go on Hamilton's website, very nice website. You could see all the information, the holdings, etc., etc., etc. So just to confirm, Nick, right off the bat, these all three of these ETFs, you could buy them and sell them and get your dividend in Canadian dollars, right? These are Canadian dollar ETFs listed on the Canadian stock market.
That's correct. Yeah, these are
Okay,
all
perfect.
Canadian ETFs listed in Canadian dollars.
All right, Nick. So you confirmed, semi-monthly distributions, so two a month or 24 a year. Just curious, why not weekly? If I remember correctly, we had discussed this, and you don't have the ability to do weekly yet. Is that correct?
Yeah, that's correct. Weekly is something we looked into and we wanted to try to have for this product. But there's a lot that goes into making the distributions, paying them out, and currently it's not possible for us to do weekly. So semi-monthly was something we knew we could do, and we decided to go ahead with that.
Okay, sounds good. So buying them in Canadian dollars, getting your dividend in Canadian dollars, even though some of them invest like SDAY and QDAY in the US, you're still buying in Canadian dollars, semi-monthly distributions. What about .u versions? Like HYLD, you got HYLD.u in case you want to buy it in USD. I know you can't talk about future launches, but are you guys maybe thinking about .u versions down the line?
Yeah, I mean, look, I think once a product gets a certain amount of success and we get a lot of, investors, who ask for, the dot use that's something that we can always look into in the future. For example, with SMVP, which is our champions ETF, we just launched the SMVP.U 6 months later. So that's something we can always do.
Okay.
But right now we feel like for Canadian investors, well, for the most part, they'll be looking at Canadian dollars.
Okay, perfect. So the moment I've personally been waiting for, we've gone through the basics, the covered call strategy. This is what I'm extremely curious about. So can you go over the covered call strategies that the three ETFs are going to be utilizing? On your website right there, it says flexible coverage ratio adjusted daily to target yield and attempt to preserve upside. Tell me all about the strategy.
Yeah, and so this is the part that we wanted to make sure we got right, and spend a lot of time thinking about what's the best way to approach a daily cover call strategy. Because there's a lot of different ways to do cover calls, but when you multiply the amount of trading by every day from every month, you want to make sure that uh, you know you're doing it the best way that you can possibly do it. And as with covered calls, you're giving up upside when you sell your call in exchange for the
Yeah.
premium you get today. And so with these covered calls, because we're doing it every day, we wanted to make sure that we weren't selling on all the portfolio. And so currently, we're looking at about 25% of the portfolio that we're writing options on, and we have some flexibility. So in a higher volatility environment, we might reduce that coverage. In a lower environment, we might increase, although we don't expect to have to increase that coverage much more than 25%. We still want to have that flexibility to do that. But finally, what we really want to make sure is that we're getting enough upside from the underlying ETFs, and that's why we use a little bit of leverage,
Yeah.
25% leverage, modest leverage, and that allows us to still get a good amount of upside, despite the fact that we're writing daily options.
Okay, pero when you say approximately 25% coverage, do you mean that's on 125? Is that
Yes.
on,
So
okay.
so yeah. So you're gonna be long 125 for every dollar you invest. You're gonna have about 125 or $1.25 of longs, and then 20 of that 125, 25 is gonna be the amount that we're writing the options on.
Okay, so 25% if we're talking including leverage, if we just say like normal,
Right. Or
100 is every
20% of the
20%. Okay, yeah.
smaller amount. Yeah.
Perfect. And will other types of call options be used, or is this going to be exclusively like zero DTE daily calls? Or do you have the flexibility, or you're just aiming for the zero DTE for these three?
I mean, we have a little bit of flexibility if we need to, but we really want to focus. The strategy really focuses on the zero DTE options. This is where all the liquidity is. We think this is where we can get the best yield because we're writing the options every day.
Yeah.
And one of the key elements of the strategy, and this is something that we can't really do in other cover call strategies, is capture the overnight improvement in share prices. Because the options expire at the end of the trading day, on the overnight of the portfolio, we don't have any options written because we write them first thing, in the morning. And
Okay.
so, when the market goes up overnight, which it does often because of news, because of economic news, and if you look at historically, overnight moves can make a substantial portion of your total returns. Uh, we're able to capture those returns by doing the strategy that way.
Okay, great. Yeah, that's a lot of the providers in the US have told me that that's a really good thing. So basically, you're the covered call, you're going to write it in the morning. It ends when the trading day ends,
And yeah,
and then overnight, if there's any ups or downs, you're capturing that fully.
yeah, and that adds a little bit of a beta to the strategy in the sense that if earnings come in after 4:30 and they're good earnings, that will drive the market up. Or if there's some good economic numbers that come out in the morning at 8:30, that can help the market up.
Yeah.
It can be a two-edged sword. On the other hand, if it's bad news, I guess the market will be down. But overall, over the long term, it does seem to be a very beneficial thing to have.
Okay. Okay. Before I talk to you about the moneyness of the options, I'm having a hard time figuring out like the order of the questions, but let's actually
Yeah.
look at what you're writing covered calls on. So if I just share my screen, let's just look at Just very quick, the three products. So you have CDAY, which is going to have, and remember everyone talking to my audience here, this is on 125%. So 100% in the Hamilton Champions Canadian Dividend ETF, which holds quality Canadian dividend stocks. And then you have the rest in VU. SDAY, very, very similar, except it's in the US dividend ETF, Champions ETF. And then the other portion is VU once again. And then QDAY, you're actually going to hold the XLK ETF. And we're going to talk about each ETF specifically in a little bit. But the rest is in QQQM. So can you tell me for CDAY, SDAY, and QDAY, where, like, what are you actually writing those zero DTEs, those covered calls on? My guess is that CDAY, SDAY, those are going to be S&P 500 zero DTE calls. And then on QDAY, it's going to be NASDAQ 100 zero DTE calls. Can you confirm that?
Yeah, that's correct. And a lot of the liquidity, or most liquidity in these zero DTE options, are in the index options themselves. So
Yeah.
you're actually trading index options, and to be covered, for you to be having a covered call strategy, you need to own the underlying index. So you could either own every stock in the index, which would be a lot of trading and a lot of share ownership, 500 for the S&P and 100 for the NASDAQ, or you could just own the underlying ETFs, which is what we do. So we own VOO for the S&P 500, and we own QQQM for the NASDAQ 100. That provides the underlying ETF, and then we sell the index option, which are very liquid. You don't have to sell as many because the size of these contracts is bigger, so your trading costs are lower in terms of both bid offer because of the higher number on the index. The Nasdaq is a 22,000 index level. The S&P is 6,000 index level. So you got tighter bid offer spreads, lower commissions, and when you're
Yeah.
trading every day, that really adds up.
Yeah, for sure. So you're not actually writing the zero DT calls on VU or QQQM.
No,
Those are kind of like the collateral for you to be able to write the index calls. I'm
that
just
is
guessing.
correct.
Okay.
Yeah, that's exactly right. Yeah.
Okay, perfect. So can you say that your exposure for CDAY and SDAY is really that dividend champion ETF, which there's no covered calls on that portion, right?
Yeah.
And with the other with QDAY, it's that XLK ETF, and then the portion that's VU or QQQM, you don't really have, like, are you actually investing in the S&P and in the Nasdaq
Yeah.
100,
I
or
mean,
on that?
that's a fair question. And I think, look, it's like any other, covered call. We still own the underlying shares, right? We still
Okay.
own the VOO. We still own the QQQM. So there is some exposure to the portfolio for those indices. It's just that we're mostly going to be written 100, close to 100% at times on that position, and so you're going to get some of the volatility associated with it, but it is going to be quite a bit reduced uh, from what an uncovered position, obviously. But if the market goes down, you will have some exposure there. If the market goes up a lot, if we're not fully covered, you're going to get some appreciation, as well. But further to your point, the majority or the vast majority of your exposure is going to come from the CMVP on CDAY, from the SMVP in SDAY, and from XLK in QDAY.
Totally understand. That makes perfect sense to me now. So, okay, in terms of the moneyness of the options, now the typical Hamilton way is you don't do it on a lot, but you do at the
Yeah,
money call. So, are you going to be
right.
going in every day, every morning? You're going to decide, okay, today we're going to do at the money. Today we're going to do 1% out of the money. Do you have that flexibility depending on market conditions, or you're just going to go in and pretty much almost do an at the money call on that 20% portion?
Yeah, I think for the most part we are really focusing on the at the money options. What we're hoping is that, or at least with the historically, what's the case has been that because the market's open, higher, more than they open lower, we're able to get good strikes on those options, even if we sell at the money options. So we don't have to write far out of the money options. And like in all our cover call strategies, we really feel that we would rather write an at the money option and get more premium and write less of it. And that's why we can still get good premiums and good distributions by only writing on that $25 or that of the 125 or that
Yeah.
25% on the 125 amount of that no matter how you want to look at it, but we can still get a amount of premium on that amount and allow for the portfolio to appreciate. One of as you know, one of the risks with covered call strategies is even if you write options out of the money, if you're written on 100% of the portfolio,
Yeah.
you're giving up all your upside. And there are plenty days historically and in the near past recently where the market can make some big moves, and you don't want to be 100% written during that time.
Yeah, that's there's definitely a question coming up on that. I already know exactly what you're referring to. Okay, so that makes sense. So just to be clear, I want the audience to be clear here. Yes, you're writing pretty much at the money or close, but you're only doing it on 20% out of 100 or 25% out of 125. So yes, you're at the
Yeah,
money, which means you're giving up, but you're doing it on such a small portion that is really funding the income and the yield, and then the rest is just completely not touched, the other 80%.
that's correct. Yeah,
Okay,
exactly
perfect.
right.
So let's talk a little bit about distributions, then we'll get into the specific ETF questions because the three of them are a little bit different. How stable do you expect these semi-monthly distributions to be? I mean, you declared already for all three of them. We don't know when the first ones are going to be paid out, but I'm assuming that's coming soon. So have you done back testing to see, the level of stability you can maintain?
Yeah, so you can expect some variability in the distributions, and the one thing about daily option writing or using ODT options
Yeah,
is that there's the volatility on those options can move quite a bit, over even smaller time frames, and it will move more on the short end, like on the 1 day end, than it will move, if you're using 1 month or 3 months. The change in volatility can be quite significant.
yeah,
And so furthermore, because these ODT options have only been around for less than 5 years, it's quite difficult to go back and do the same kind of modeling and the same kind of back tests that we've done on our yield max, for example. So I think we feel comfortable with the distribution that we put out for the next little few months or whatnot. But you can expect some variability month to month, and you can also expect that we may have to reassess as this market grows, as these ODT options change over time. This is
yeah.
still a changing market and a growing market.
Okay, so we can expect some variability. Would you say similar like the yield maximizer, where there is variability sometimes month to month, but it's not big up or not big down? Maybe along
Yeah,
those lines?
yeah, along those lines, maybe a little bit more, in fact, because
Okay.
with the monthly yield max
Yeah.
strategy, we have been able to go back. We have more data to go back on. We have 15 years of back tests for those. For this one, it might change a little bit more, but still, we wouldn't come out with these distribution numbers if we thought that these aren't distributions that we can achieve at least in the short term. So,
Okay. Okay, perfect. Now, okay, last general question, the tax efficiency. So I've been already getting questions about these. We could really do a good educated guess on the tax efficiency of these. I would
Yeah.
say because we know what they hold, right? So if we just
Yes.
do CDAY, I mean, you're obviously going to get some Canadian eligible dividends because it holds CMVP. And then the covered calls in Canada, as we know, even the zero DTE, right? Correct me if I'm wrong, it's capital gains income. So I would say, and maybe I'll say it and then you could correct me if I'm wrong. I think for CDAY, you're going to have a little portion of Canadian eligible dividends. The rest will pretty much be capital gains and or ROC. For SDAY, you're going to have a small portion that's foreign income because SMVP.U will generate US dividends, which for us is foreign income. But the majority, of course, is going to be capital gains and ROC because that's the covered call. And then QDAY, you have XLK and QQQM. XLK has a I checked the other day, a very, very tiny dividend. So does QQQM, but I would say for this one, the overwhelming majority is going to be capital gains slash ROC because that's what option income is. Do I have any of
Yeah.
that right?
Yeah, no, I think you pretty much nailed everything on the head here. I think for the when you're looking at cover call ETF, a zero DT option is not really any different from the
Okay.
taxation side than a regular monthly option, and because we're going to get underlying dividends
Yeah.
from the CMVP, from the SMVP, but the vast majority of your distribution is going to be tax efficient in the form of capital gains and for sure.
Perfect. All right, let's go to CDAY and SDAY, some specific questions for these. We already confirmed that for these, you're writing SPX or S&P 500 calls, so we could skip that question. Okay, so this is a big one here, an important one. Why did you decide to make the dividend stocks the focus? So obviously CMVP for CDAY and SMVP for SDAY. Why not put, for example, HDIV or HYLD, HDIV and CDAY and or HYLD and SDAY, for example, to even have more yield? Why not put those with the zero DT? Why did you guys decide on the dividend ones?
Yeah, I think we wanted to have a That's a good question, and I think we wanted to have a product that is balanced in the sense that we're getting income, but we're also getting potential upside. And one of the issues with having too many cover calls in a portfolio is that you do limit more of your upside. And so by having the CMVPs and the SMVPs, for example, those aren't capped. And so, even though you're getting good premiums and good income from the covered call portion, you still have a balanced approach. And so you still have more of that upside. Of course, you're not getting as much income, but it's more balanced. And we feel with the level of distributions that we're paying, that's still fairly attractive for income investors. In addition, I would say the reason we chose to put in the Champions ETF in those ETFs is because they have those higher dividend yields, so that we could still use that to even though it's not the majority of where the distribution is coming from, it still helps to some extent by
Yeah.
having higher dividend stocks in there relative to just owning the broad index.
Yeah, and I would say they're also probably less owning those champion ETFs or less, it's a little bit less volatile than owning just like you could have put 125% VU or, but it's the dividend stocks or dividend growers, which tend to have less volatility, a little bit more stability. The way I
Yeah.
see it is, I'm a firm believer there's three types of investing: growth, dividend, which focuses on dividend stocks, and income, which cover calls. This is kind of like the dividend meets the income, right? You have the
Yeah.
dividend stock, so it could be a good. What do you think those two ETFs are designed for? I think it could be a good way for dividend investors who really like or attracted to dividend stocks and get a yield boost with the
Yeah.
zero DT strategy. What do you think?
Yeah, I agree. I think this obviously the CTF is designed for investors who are looking for more income, for higher yield from their
Hmm.
investment. And this is this is also a different approach from traditional covered calls because we're writing every day. It's a bit of a different return than what you might expect if you're selling, monthly options. So from that perspective, it's a little bit you get a little bit more diversification, even if you already have a covered call in your portfolio. This is another way to get income from volatility, but using a different approach. It also kind of helps you, get cash flow at different times instead of having to wait monthly for your
True.
distributions. These are more frequent because we're able to get the premium more frequently. So I think from an income investor's perspective, these provide a bit of a different approach, a different way of monetizing the volatility in the market.
Yeah, yeah. I've been getting some messages about members and subscribers that already have HDIV and HYLD, and they're already starting to think, well, should I swap my HDIV to CDAY? Should I swap my HYLD to SDAY? But just like you guys have from the get-go said, HDIV and HYLD could be a good complement. Do you think these could all be, CDAY be a good complement to HDIV and SDAY be a good complement to HYLD, for example?
Yeah, I mean, I think absolutely. And we wanted to be a little bit different from the products that we already had. And so CDAY, SDAY, because of the daily volatility component, it is, you can really think about that as a different strategy.
Yeah,
And further to your point, one of the reasons we wouldn't want to use HDIV and HYLD inside of the CDAY and SDAY is because then you have you don't, it's no longer a pure play on the zero DTE strategy.
right. Okay, cool. It makes sense. So, and just to confirm, these are, well, CDAY, we don't have to talk about it, but QDAY and SDAY, those are not going to be hedged to the Canadian dollar, right? There's no currency
No,
hedging like HYLD does.
no, there's no hedging on those. And maybe one day we talked about it earlier, but maybe one day we could have the dot use, although we don't, that's not currently. But the hedging, it adds an additional layer of complexity, and especially because now we're getting premium every day, and we're trading these options every day. We'd have to re-hedge the FX every day alongside with it. It really added a lot of additional steps, additional work that really, didn't, we didn't think that we really needed that
Yeah.
currently. Yeah.
That makes sense. And I got a comment the other day saying, well, SDAY is hedged to the Canadian dollar because it has SMVP and SMVP is hedged to the Canadian dollar. And I would say, no, SDAY actually holds SMVP.U.
Correct.
So SDAY is not hedged to the
Yeah.
Canadian dollar. Okay,
Yes.
perfect. So QDAY, let's move on to QDAY, the tech focused one. Um, and you confirmed that already. These zero DTE calls are going to be on the Nasdaq, on the NDX, not
Yes.
on the S&P. Okay, which we know is a little bit more volatile, which means a little bit more premium. Okay,
Yeah.
perfect. So why did you decide on XLK? Well, we kind of already discussed a similar thing. You decided to put XLK as the
Yeah.
primary ETF. Why not, for example, QMAX?
Yeah.
Or why not, for example, just have just QQQM 125%?
Yeah. And I think, I mean, yeah, exactly. We talked about that a little bit. We wouldn't want QMAX again because we want to make sure that we're really focusing on the zero DTE strategy for these products. So, QMAX is really focused on the traditional 1 month type cover call strategy. In terms of owning XLK versus QQQ, we really wanted a product that was really focused purely on technology. And as you know, the Nasdaq 100 has non-tech stocks in it.
Yep.
Um, XLK over the last 10 years has outperformed QQQ. So we think that was a positive for the product as well. And it's also a lower cost ETF for investors. It only costs 3 basis points to hold it. And so really, like, in terms of cost advantage, performance, it really made a lot of sense to own that one relative to just owning the QQQs or the
Okay, yeah,
QQQM.
that's a pure technology one, right? I was
Yeah,
looking at the
pure
other day and I
technology.
noticed there's no Amazon here, there's no Tesla, there's no Meta, no, there's Apple, Microsoft, and Nvidia, which is like 45% of the ETF. This is a pure technology, but you do still have a little bit of QQQM, which is the Nasdaq
Yes,
100.
for the
It
for the cover call strategy.
for the cover call strategy, exactly. It doesn't surprise me at all that XLK has outperformed the Nasdaq because technology stocks have
Yeah.
outperformed.
And
Uh,
with all the days, we want to make sure with the portion of the ETF that we're not writing on, so the XLK for the QDAY and the MVPs for CDAY and SDAY,
yeah,
we want to make sure these are really good ETFs in of their own that have done very well. The indices for the champions that track the champions that we follow with our MVPs have done well relative to the S&P 500 or the SPTSX. They have lower volatility. The MVPs have the indices have lower volatility over 10 years, and so these are really and higher yields. So these are really ETFs across all the days that we like, and you really when you own cover calls, regardless of it, whether it's zero DT or whether it's regular covered calls, you always want to like the underlying.
yeah. Of course, I must have said that a billion times throughout my YouTube career, if you will. That's all. It's always the most important thing. You're investing still in the
Yeah,
underlying, no
yeah,
matter what. So maybe we could just clarify the fees real quick. All three of them have an 85 basis point management fee.
yeah,
Those, the MER is going to come out next year, but the MER is going to be much higher because it's going to include leverage costs,
right.
obviously, which a lot of people still don't understand. But you're just to clarify, in case there's newer investors, CDAY owns or holds CMVP, but you're not paying a double management fee, right?
No,
It's just 85
no,
on the top. Same thing
yeah,
for SDAY. And for the record, VU has a 3 basis point MER. It's
yeah,
practically nothing. QQQM, I just checked, has 15 basis points,
yeah,
very, very low as well. And XLK is very low. It's actually it's 8 basis points, 0.08. So obviously, Hamilton, by holding them, you're going to have to pay those underlying fees, but they're super, super tiny.
yeah. They're very very small. And
Okay.
yeah.
Guys, sorry, go ahead.
Yeah, no, I was going to say, the 85 base points in terms of the management fee, it is slightly higher than we currently charge for the Guild Max. But that's because we have to do a lot of times more work to trade these
Yeah.
products, um, and because you're not paying the fees in the underlying in our underlying MVP at the ETFs, it still works out quite well after the given the distributions and the work.
Yeah. My personal opinion, it's very competitive because in the US, they're typically 95, 99 basis points. So these are actually a little bit less than I expected. So my opinion here, very, very competitive management fees, maybe 20 basis points more than your standard cover call ETF fee
Right.
in Canada. But of
Yeah.
course, you're doing it daily, a lot more work, obviously, right? Okay,
Yes,
so
exactly right.
now we've got a question I've been burning to ask you, but you kind of touched on it a little bit. I made a whole video about this. April
Right.
9th was a disaster for zero DTE covered call ETFs on the US. That's the day where the market, I think the S&P went up 10% in one day, which is, I don't think it ever did that. 12% on the Nasdaq. So
Yeah.
obviously you're writing a call and you're covering 100% of the portfolio, you're in big trouble. I see a lot of those ETFs go up 2, 3% where the market went up 10. That's a big, big gap. So have you guys thought about how to mitigate these types of one-day giant rallies in case they happen again?
Yeah, and one day giant rallies or one day giant moves in general are all as an options trader, these are always something that I keep a close eye on. And because it really is really going to matter quite a bit for the performance of a covered call strategy. And this is why I've always espoused the strategy of writing fewer options at the money as opposed to more options out of the money. Really, that is the main reason. But those events in April 9th were really not a wake-up call, but a confirmation that we didn't want to be in the same position if we had our own ODT ETFs. And so because we're only riding on a 20% of the portfolio or 25% after the leverage, we still have plenty of upside to make up if we get a big intraday move. Because 80% of the portfolio and even 100% after the leverage has upside and is not written. And so even on a day like that day where the market was up 10%,
Yeah.
we're going to give up the upside on the portion that we're written on, but we still have plenty of opportunities to benefit from the upside from the rest of the ETF. And we live in a world now where these kind of intraday moves can happen at any point. It doesn't take much. And so that's something that was really important for us to make sure that, should those days happen in the future, and I don't think there's any good reason that they won't, to make sure that we still capture a good amount of upside in the portfolio.
Makes complete sense. Once I figured out, hey, they're only covering 20%, 80% of the portfolio is untouched. Well, that basically is your answer. In the US, they mostly cover 100%.
Yeah.
So obviously when you're covering 100%, yes, you're taking in big premiums, but you're getting that risk of not capturing that upside during a crazy up day.
Exactly right.
Okay, this is personally why I prefer the Canadian covered call ETFs, because all providers typically they don't write, nobody writes 100%. I mean, that's they always want to capture some upside. Okay. So Nick, let's take some member questions, some paid member questions. We've touched on a lot of these, but I'm going to ask the questions straight up because I think they deserve it. They're very good questions. And by the way, I'm talking to my audience here in case you're interested in becoming a member, being able to submit a question for a future Q&A. Hit that little join button. You'll see what it's all about. So the first question is about tax efficiency. So they claim tax efficiency. What makes these more tax efficient than other covered call ETFs they offer? I don't think you were saying more than our current covered, just in general tax efficient.
Yeah. No, I think in general they're equally tax efficient. And I think that's an advantage for all covered call ETFs, but this doesn't change for this covered call ETF. We get the exact same tax efficiency as we do in our max, our yield max.
Yeah, and that's simply because covered option premium income in Canada is considered capital gains, so it could be classified as capital gains in ROC, and the majority of the income is options income. So that's,
and we're good. The MVPs have some dividend yield there, and that is going to be taxed as dividends, and then the U.S. Dividend yield we're going to get that will be foreign income, but still the vast majority is going to be coming from the premiums.
Sounds good. Next question. Looks like a great product. How are they mitigating the price erosion? I love this guy because he said price erosion, not NAV erosion. It's a big pet peeve of mine.
Right.
The price erosion that most zero DT funds are experiencing in the US side.
Yeah. And we didn't actually get a chance to talk about that too much, but one of the other so we talked about now writing on 100% of the portfolio. That to me is really the biggest reason why we can maintain the upside in the portfolio, and that can help with the price performance. The other way is through the flexibility in the coverage. One of the things that happens around April 9th, for example, and when we had a lot of volatility going into that week with Liberation Day and all the talk of tariffs, and so the volatility in the options at that time was really quite high.
Yes.
And to get the premiums that we need to get our monthly or bi-monthly distributions, we didn't at that point, we would have not needed to write as much of the portfolio. Maybe I'm not sure what the exact number would have been, but it would not have been the 25% that we're talking about right now. It would have been quite a bit lower. And because we have that flexibility, we actually would be able to get potentially more of that upside in a recovery. So I think that's one of the key aspects that we use in all our covered call ETFs, not just the
Yeah.
DayMAX, but to really like adjust our coverage depending on the volatility environment. And we've now been through quite a bit of volatility over the last year, and we can see whether it was in April or whether even in 2022 or even during COVID, adjusting your coverage levels based on the volatility environment can really help you protect some of the potential upside in the portfolio.
Okay, so basically what you're saying is you guys are really focused on maximizing upside potential, maximizing total
Yeah,
return. You're not just here to write and provide income. Obviously, these are income oriented, it's income first, but if you're making your premiums with less coverage, or you'll do that rather than take in more premium. That's what I'm
yeah,
kind of hearing.
that's right. We're not trying to get as much premium as we can, no matter what the environment is. We think we have these distribution that we can meet, but once we've met those levels and we don't need to write anymore, then I don't see a reason to add more coverage, just and limiting potential upside just
Yeah.
to get more income that month.
That should be music to that person's ear, whoever asked that question, if you're worried about price decline over the years. Okay, perfect. Here's a really good one. This is I actually didn't think of it. Then I saw it. I'm like, that's a genius question. And I know you guys can't really talk about like future additions on products and things like that, but I'll ask it anyway. Will any of them, meaning the new ETFs, be added to HDIV or HYLD?
Yeah, and this is a question that has been brought up by many investors,
Okay.
and this is something that we're looking at. We can't say too much about it. This is a decision we're something we're looking into, um, but certainly many investors have expressed interest in seeing that happen.
Okay, sounds good. You're looking into it. That's good enough for me. Last question. I think we kind of already talked about this, but it was a well phrased, thought out question. So, Hamilton ETFs primarily uses at the money cover call strategy in many of its ETFs. I assume this approach would apply to the new funds as well. We discussed that.
Yeah.
Could Hamilton adopt a dual strategy to dynamically adjust its cover call approach based on market trends, potentially enhancing total return? Does Hamilton currently employ an active management team that will utilize a dual strategy, selling at the money cover call options when markets are trending lower and out of the money options when markets are trending higher?
So that's an excellent question. Look, it's also a very difficult question to answer. If I had a crystal ball, of course, I would write out of the money options when it was right to do so,
Yeah,
and I would write at the money option when it was right to do so. It's difficult to consistently know when a market is going to be trending one way or trending another way. Though there are few things that we can do to help. Um, and the first thing we've already talked about, which is adjusting our coverage. Now, for zero DTE options, we really only trade in the morning, and we get our premium. We don't have that much flexibility in terms of okay, now the market is up. Is it going to keep going up? Are we going to write further out of the money options? Because we're only getting premium for that one day. The best thing to do is to really just get as much premium as you can right after in that opening moment, and then capture the premium, because the longer you wait, the less premium you're going to get from those options. They're going to start to time decay pretty quickly. Um,
Yeah.
Now, in our, more generally in a covered call strategy where you have more time to trade, like we do in our yield max, where you can trade over the month. Um, if we think, if the markets are trading higher, we will be able to capture that because we're not trading all in one day. We're trading over a week or over a couple weeks. We're selling new options at higher strikes as the market trends. So that is helpful in capturing premium. But the at the money strategy always gives you the most premium. So
Yeah.
we're income first. We always want to make sure that we're getting the most premium possible. And a lot of call writers, they look at the out of the money options and they're like, well, at least I'm not giving up as much upside. But you're getting significantly less premium,
Yeah.
and that's always the trade-off you have to ask yourself.
Awesome. That's great. So, Nick, you've been with us almost for an hour here. Really appreciate your time. I know you're busy, but thanks again for doing this. Really appreciate it. And we'll talk again soon. Tthanks so
All
much.
right. Thank you very much. Thanks for having me on.
Of course.